Good afternoon, everyone. This is Chris, or could be good evening or good morning almost to some on the call. Thanks for taking a little bit of your time, and again, we're going to, in case you have insomnia, we're going to record this so you could watch it again, later on. But really appreciate for those. I know everybody has busy schedules all over the world, and so we're just glad for those that can attend. This is our second in our series of the Connect series with premium members. Kind of hard to believe that a month has went by since our last one, already. For just a reminder of old members and new, and just to remind myself, Kimball Charting Solutions is not a bull or a bear shop. We believe being bullish or bearish is nothing more than a psychological state of mind, and it's not a strategy. So we attempt to apply and hopefully successfully as strategies as the markets see fit. Kind of wanted to wish you a happy new year because time's flying really quick, and I don't know, does it seem just like it was 33 days ago that you were toasting champagne and maybe kissing a loved one or hugging a friend, or something like that? But it's hard to believe that we're 33 days after the New Year's Eve, and a lot has happened, across the world in the first month of this year. And so I kind of wanted to just talk about a second that when it comes to technical analysis, I think that the things that we have to look at is, there's messages coming from the world. There's always possibilities. I actually was getting my hair cut from a new person who was cutting my hair, and she said, "What do you do?" And I said, "Well, I'm really not a very smart person because I attempt to figure out or attempt to try to know where the herd of people will be in their thinking weeks or months in advance." And she thought I was just kidding, but guess what? You also do that, the other people on the end of the line, that we're all trying to guess where the herd will be going forward, and we have the power of the pattern as our friend and our tools. And so I just kind of always want to think about in Plan Bs is, what do we do if support holds? What do we do with different investments, the sizing of positions that we take, the different ETFs, stocks, or indices that we can buy, and right now, what do we do if support breaks? So we want to always have these Plan Bs, A's and Bs, and I apologize that I'm not so smart to know exactly where this whole herd is going to go. But I don't know if anybody of you recognize what this animal on the screen is, and it's a chameleon. And what do chameleons do to protect themselves, survive, and thrive? Well, they adjust to their environment, and they make changes. They don't try to push the environment. They just accept the environment for the way it is. They make those adjustments, and really that's what we're trying to do at Kimball Charting Solutions, is with the power of the pattern, make the adjustments that the world suggests that we should take. Our whole attempt, as we said earlier, is not being bullish or bearish. We're attempting to help empower you so that you can enlarge your portfolio regardless of market direction. So I was just trying to think about it the first of this year. If you had anybody have a crystal ball, you can think about 33 days ago, what all has happened. Did anybody see all that took place in the last month? I didn't. I didn't have a biotech, or did any of you have a crystal ball that said biotech's going to fall 20 to 25% in the month of January? Well, very humbly, I didn't, but we did take advantage of that decline. So when we kind of look at what the past month has brought, you can see starting at the bottom that the S&P was off roughly 5%. Tech was off a little bit weaker, transportation off 8%, small caps were off close to 9%, with biotechs the winner on the downside. And just kind of wanted to give you an example of some of the trades that we made during the month. There was a time that we tried to buy biotech on support, and we're going to be wrong. I try really hard, everybody, and I apologize when I'm not right, but I can't seem to get around being wrong about a third of the time. So I humbly accept that I'm going to be wrong. It's just our key is we just hope not to be wrong for very long. So you can see that we lost a couple of percent on the biotech position, but when it came to the indices for the month, the negative numbers on the right became our friends as we shorted and found inverse ETFs that were our friends, and these were closed trades on and aggregated returns on. I do different sizings, and one of our members asked a great question for this, and one of the rules that I've tried to abide by on sizing different things is what I call the 10-10-10 rule. And so if you had a $100,000 portfolio, or per 100,000, if you took a 10% size position, and that's what the first 10 stands for, you'd have a $10,000 position per 100. And so that's frequently what I'm doing. The second 10 then comes into play is I'm going to start harvesting on around a 10% gain. And then the third 10 is, what if we could do that successfully 10 times per year? So let's think about the math. We had $100,000. We set aside a 10% position. We had a $10,000 position. And if it made 10%, that's a $1,000. We have a 1% gain on the overall portfolio. Excuse me. And so what if? So with that 1% gain, we had 90% not at risk, 10% at risk. We had a 1% net gain. And what if we did that 10 times per year? You know, I played baseball in college, and I think about Babe Ruth, that you know, that he was famous for his home run, you know, ability. But for some of you baseball fans, you might recognize these names: somebody by the name of Ted Williams, Rod Carew, Tony Gwynn, George Brett from Kansas City. They're all in the Hall of Fame, yet they really weren't that famous for their home runs, but they were famous for their batting average. And so at Kimball Charting, we're really not trying to go for home runs very often, humbly. I'll feel blessed if we could find one, and if they're out there, we'll take them and we'll try to ride that horse for as long as we can. But it just seems to be a lot easier that we can find singles and doubles to hit. And so, you know, a lot of people, when you look at what our inverse position in the Russell or the Qs in the Nasdaq or the biotech, a lot of times that's an okay return for a whole year. But we were able to pick that up in the first 30 days. So John M. That had asked about the 10-10-10 and positioning sizing. So you'll see in a lot of my emails, everyone, that when I say a small position, I'm typically then looking at a 5% instead of a 10. That's about half the size. So just kind of wanted to share in one of the responses to one of the questions. I didn't have a slide on that, but I appreciate, you know, that question, and glad to talk about the 10-10-10 rule, you know, going forward. So you know, I don't think the markets were bad in January. I think they behaved well according to the patterns. A lot of people said they were, you know, that it was a bad situation. I think, you know, it was only bad if you happened to own it. And so we didn't own these positions. We actually owned the inverse. So we feel very blessed and lucky to get off to a good January. And very humbly, I'll try to do my best not to screw up the rest of the year. We got off to a good start, one of the best starts that we've ever had. So one of the reasons that you know, there's a possibility, everyone, that you know, we won't know. I'll probably be long gone by now, by that time. But you know, we have a chance to look back 20, 30, 40 years from now on the patterns that we saw last year, and they could be taught in technical analysis classes. And here's why I think they could be historical, you know, situations. So last May, we went and recognized and shared to the, you know, all of the members that it was very rare that in the upper left, you looked at the Dow, if we took the 2007 high and low and we applied Fibonacci to it, that the 161 Fibonacci extension was coming into play, and the exact same thing was happening in the S&P. Germany, the DAX, was hitting a Fib extension based upon the 2000 high and the 03 low, and the Nasdaq was back at its 2000 highs or the .com highs all at the same time. So if we look in the upper left, kind of look what happened after, you know, it hit that resistance. You can see that the Dow has faded, you know, down. That was a monthly chart, so it's not yet at a new monthly low, but you can see that it's had a series of lower highs. In the upper right, if you watch the S&P after hitting 161 Fib, we see a series of lower highs, lower lows. What about the DAX index? We can see that it's just done the same thing. And then after the Nasdaq hit the 2000 level highs, you can see that it's turned weak in the upper right. So this was, to me, a very, very rare situation, and nothing's proven, you know, yet, folks. But definitely, we've tried to talk all year. This is when we scaled back to the lowest percentage towards the slow money concept for the financial professionals and RIAs on the call. And so, as it was a rough last part of the year, we only had a 35% exposure, 25% some of the time, and so that position has lost a little bit, but nothing like, you know, the broad market itself. I really think, you know, when you think of shades of gray, you know, a light switch is on or off. We don't try to run portfolios or suggest portfolio management in that direction. Just try to do some shifting, scale in and scale out. It's really nice if you could just take one lump sum and hit one certain spot and you were a real winner. But I don't think, you know, when I ran a practice for 25 years, we didn't try to do that then, and I wouldn't suggest to try to do it now. So after all, I know this is a busy chart, everyone, and just hang with me, but what this is going back to the date that all of the world markets hit the 161 fib levels, and off to the right is the 9 S&P and including the S&P 500. The S&P 500 is right where my mouse is, so you can see after hitting the fib 161 levels, the S&P is off 10%. I kind of tried to highlight the zero line that so far, since fib hit 160, or all the markets hit the 161 fib, the only two indices that are actually higher since that time are utilities and staples. And not a lot to brag about, but at least they're above water. And you can see then in the bottom dwellers, energy off almost 30, with materials and financials bringing up the bottom. So, but for the most part, you can see that these have created, especially since November, a series of lower highs, with the strength being in utilities. So pretty heavy resistance that still sits up there at the 2150 level in the S&P 500, and if it can take that out, it'd be very positive for the world. But so far, that's about the 800-pound gorilla sitting up there. So you can just kind of read this. Be careful when you follow the masses, because sometimes the M is silent. We're a real proponent of avoiding crowded trades. We try to look for inflection or turning points. And so as the masses may have gotten involved too much in the excitement when the 161 fib levels were hit, we did the opposite of the masses, and we've been able to avoid a lot of those declines. And don't forget, like I shared last week, that Joseph Kennedy in 1929 was told by the shoeshine boy 10 stocks to pick. He was already a millionaire at the time. He went back to the office and said, well, if the shoeshine boy is telling me that I should buy stocks, there's nobody left in society to buy them. And he went to cash, and the Dow fell 90%, and he gained 900% in purchasing power. So think about this. He sidestepped that big decline, and then he was able to buy 9 times as many American corporations in 1932 than he was beforehand. So as we're stepping aside and missing the huge declines in a lot of these commodities, silver's down 65%, oil's down 65%, we can just find these all over the place. Avoiding a 65% decline right there increases your purchasing power by almost 300%. So someday along the line, these are just going to be screaming buys, everybody. And I'm not promising a thing, but I came into this year really, really excited that we would see movement, and that we could harness and capture and take movement to our advantage. And so far we've been able to do that, and I think we're going to see a lot more movement for the remainder of this year, and a lot more opportunities. So this past weekend I asked, which was your favorite trend? Was it a 6-month trend, a 1-year trend, a 2-year trend, or a 5-year? And so this is the same chart. This is the S&P 500 looked at in 4 different time frames, 6-month and the lower highs and lower lows. Now the 2-year trend, if you go back to 2014, the S&P is essentially where it was. So it's in a sideways chop from between about 1850 and 2150. So it's just been back and forth. So I don't really think bulls or bears have much to brag about either way. So you'd want to be in the 2-year trend, a buyer on support and a seller up at resistance. The 5-year trend is pretty important to me in the right, that you continue to see a series of higher lows and higher highs. And once this channel was hit this past year, if you'll notice, it's went from the top of the channel to the bottom, and taken a little bit over a year to accomplish that. So we have a lot of different things meeting in one price point that I think is really, really exciting and opportunistic, going forward. But I think here's a simple way to look at the situation in the S&P 500 right now. Let's just dress this chart up a little. There's our series of lower highs. There's our 1 to 2 year chop of sideways. What if we take the 2000 highs and draw a line through there? We'll notice that there's a series of bullish wicks along those support lines. And then how about the 5-year rising channels? And so we have a triple support test going on right now, which 2 weeks ago created that bullish wick. And so whether you're a buyer on support of the 1-year trend or 2-year trend, support, support. Whether you're a buyer of support off the 2007 highs, support is in play. And whether you're a buyer on 5-year rising channel support, support is in place again. So we still have this trend that's in play to the upside. but sometime we all know all channels break, and they haven't broke yet, but I want to show you some things on why I think we're very opportunistic about what's going on. One of the things I always want to remind everybody of is what goes up in a down market, and I'm not referring to an inverse ETF, but it's correlation. Think about that. What goes up in a down market, and it's correlation. So the world, I think I've shared before that Sir John Templeton, before he passed away, said he thought the world was a risky place, and he wasn't referring to that as far as the stock market being lofty. He was just referring to correlation, that it was very hard to diversify yourself in a traditional fashion of 20 years ago to reduce risk. And you'll notice that I could have, someday I'm going to do this. I'm going to promise you guys I'm going to change the names on these charts. I'm not going to be truthful about it. And I doubt that you would hardly know it because they all look so much the same. So right now you can see the world from the S&P in the upper left to the Dow to the mid caps across America. They're on the 5-year rising support. But so is Germany, London, and then France is a little bit of the weakest of the 6, and it's poked a little bit below its rising support. So again, the whole world, this is it's paid. I don't know if is it different this time, but it's paid every time for the last 4 to 5 years to buy on this support line. And of course, the billion to trillion dollar question is, will it be different this time around? I think we need to continue to look at the weak ones, what got us here. So the 2 weakest indices over the last year are the transports on the left and the Russell on the right. But you'll notice they're also in their 5-year well-defined trends. And what I tried to do is, at the number ones of each, is draw the falling overhead resistance lines. So they're both battling support, and they're not far away from resistance. And so the question, is should we buy the dips or sell the rallies? And so right now you still have to be a buy the dipper. But if these indices would fail to break above resistance and then break support, we would then move and start gravitating towards selling the rallies. And some could make the case, hey, Chris, aren't we already there? And when we look at the 6 and 1 year trend, I'd have to say, yes, we are. So here's a closer look at the weakness. Here's the transportation, and this is on a weekly chart. And I made these earlier today, everybody, so the numbers are most likely lower as we finish close to the lows of the days. But you can see on a weekly chart that the transportations hit the falling resistance, and as so far this week has created a reversal pattern. And of course, the week is not over with by Friday or by the coffee with Chris this weekend. Who knows, they could punch above it. You can see that the biotech also has created a bearish wick, and it's just above support. You can, in the lower left, you can see the same thing with the Russell. And I thought it was kind of interesting. I converted the S&P to weekly closes. That you'll notice the S&P came right up to its first 23% fib. It closed there last Friday, and then we started off the week backing off, from that. So I can't overemphasize enough how important that these steep falling resistance lines are of the weak players. If the weak players obviously would break resistance, that would be something that hadn't happened in 5 years. And if it would break short-term falling resistance, it's like a 60, 90-day trend, it would be a positive for these. So they're caught in a tight jam, folks. There's not much distance between support and resistance. The play here is to just be very patient and let this thing play out and see where the world takes it. Again, what do chameleons do to protect themselves, survive, and thrive? I just want to talk about adaptability. And here's some things that all of a sudden this chameleon would have to change colors from a trend change. I've shared with you many times, this is the biotech IBB S&P ratio. And you'll notice at the arrow for the first time, if you think about it from 2011 to 2015, I believe the S&P was up around 60% during that time frame in the 4 years, and biotech was up 200% more than that. So it was almost a 4-fold increase, and now you have this leadership breaking support. I had a premium member this week make a fabulous comment, which is completely true, or a question is, Chris, could leadership change? And the answer is yes. So right now, I'm not smart enough to know if leadership has or hasn't changed. Biotech did lead on the upside 4 years, and we have to say, what's it doing since last year? It's leading on the downside. We started the slide off with that's off 22% in the month of January versus 5% for the S&P. So you can see also it's been a leader on the downside, and so this is important to me to see how this pans out, that it's breaking 4 to 5 year support of the black arrow. Another thing that we have to look at is it changing its colors? Is the NYSE advanced decline line. So this goes back to the 2009 lows. We tied it into the 2013, and it's too tight to tell, but essentially the NYSE advanced decline line is on its support line. It is a fraction, below it. Keep in mind these are long-term lines, so there's always some fudge room, but it would be a chameleon change and a negative message for strength or lack thereof if the NYSE advanced decline line continues to go lower and break below that 5-year support. It would push you closer to being defensive on your portfolio. This would be a risk-off message if it continues. This is one I found interesting. This is XLY, which is discretionary, and XLP, which is staples, so it'd be a discretionary staples ratio. Typically, it's sending a risk-on message when it's rising, so you'll see that it has been in a uniform rising trend for the past 4 to 5 years, and you'll notice that it's poking a little bit below this rising channel. But I want you to kind of look at this red line, and so this is the lower support line that that the ratio is breaking below. So could this line have applied in this angle of ascent been important in the past? So you're going to see another red line, everybody, come in from the lower right of the screen, and I promise you it's just a parallel of this line, and I want you to watch what happens. So if you go over to the 2002 and 3 lows, and you'll notice that what did the market do in this ratio? It continued to rise, and this line was a support, and then what happened when it broke? That's when we had the financial crisis and the large decline, once that gave way. And so what we have to just, nothing is proven yet, but you can see that the same level of ascent in the same ratio, that typically means risk off when support is broken. This would be sending a risk off message if this continues, to head south. So there's several key pieces that are taking place that are actually giving way at the 5-year support before any broad market indice is. Kind of wanted to switch just to a fundamental perspective a little bit. This is the margin debt ratio with a 12-month moving average applied to it. And our take has always been that, a high margin debt, in other words, people borrowing money to invest by itself, it's not good, but we never felt like it was bad. But when negative action in the stock market took place is when it actually turned lower from all-time lofty levels. So you'll notice in 2000 here, at that time, that was an all-time high, that people had borrowed an enormous amount of money to buy stocks because they thought they could make more than the cost of borrowing. And you'll notice for the majority of the time from the 80s and up through the 90s that it stayed above this long-term moving average, or its 12-month average, excuse me. Then once it broke here in 2000, we know that the S&P got a haircut of 40 to 50%. Then you'll notice the margin debt crossed above the line, went to another all-time high. Once it crossed the moving average in 2007, then the market declined again. So in 2011, margin debt did cross, below it, but it was not at any kind of new all-time highs. Now margin debt is at all-time highs, and it's now crossed below the moving average by a small margin. So we want to pay attention and watch to see. This is a monthly report, so this can only come out every 30 days data. There's nothing in between these dates, everybody. So once we get this, then we got to wait 30 more days. But at this point in time, it has broke below its moving average. Always the power of what if. My parents, I really annoyed my parents on many different occasions in my life, but my parents and my brother were really annoyed when I would consistently ask, what if? What if, what if? But we see sometimes in people's lives, it's good that they ask what if, because this is a picture of the Wright brothers. And so we're really glad probably today that they did ask what if. And so I want to update us on the biotech. This is not the ratio, everybody. This is just IBB itself. And what I noticed earlier this month, about 30 days ago, that it was a bearish rising wedge. And so what I did was, as soon as this was broken on a Friday afternoon, we went and bought BIS, which is the 2X inverse biotech ETF. And so we attempted to score on defense, and we had some luck. but now that decline has taken IBB down to its 5-year support level. So 260 is very important. This was made this morning when it was at 268, and I believe during the day IBB today got down as low as like 259 for 20 minutes or something like that, and apologize if I'm wrong, but I think it closed back above 260. So it's right on the line, and if it would break much below this, I could see a lot of selling pressure, coming in. So a very important point when we think of a chameleon and adaptability. We've already scored on defense, but I will look to reestablish short positions again on a break of this 5-year rising channel if IBB does it. This is long-term moving averages on top of the S&P 500 going back to the last 20 years. And this is not something to use for what I would call trading signals. It's just slow-moving assets, kind of part of from a mental perspective. Should we be risk on or risk off? But these two long-term moving averages had a crossover in 2000, but I don't like crossovers by themselves. I like to see support broken at the same time. So you'll notice that there was a crossover the moving average, that the faster moving average crossed below the slower, and the S&P broke a 5-year support line at the same time. This would encourage people to take assets off the table, and that maneuver would have avoided the majority of this 50% decline. I didn't put it in here, but if you could imagine a overhead resistance line being broken at the same time as you had a crossover buy signal, then that led to a multi-year bull market. And so you didn't have any combination of the break of the moving averages and the support line until right here in 2007. Then we had a 50% decline in the S&P. So there's no red alert here, but I want us just to be empowered that the moving average has crossed over, and that if the S&P would break rising support, it would only be the third combination sell signal in this combo system in the last 20 years. So there's only been 2 signals, and they were fairly decent when we look back. So it could be important if we see the S&P break this, because we do have a moving average crossover. So from a chameleon perspective, you would change from offense to defense if we'd see this take place. So here's this lady in the crystal ball back again. Anybody have any thoughts or ever ask the question to yourselves, if the 5-year rising channel would break, how far could the market fall? We don't sit around and try to talk about financial crises coming back or any of that, but one of the things in emotional downturns, Fibonacci seems to work pretty well, everybody, especially extension levels. So what I did is, this is an S&P 500 monthly chart, and I applied Fibonacci to the monthly closing high before the financial crisis in 2007 and the low in 2009, and then these would be retracement levels if the 5-year support line breaks. So the first one would come into play around 1785. You can see the 38% fib levels at 1590, and the 50% levels at 1425. Well, folks, we haven't broke support yet. So this isn't into play, but if it would, I want us just to be prepared, have plan A's and B's. So right now we're short the S&P, and we're scoring on defense as an example today, but where would we look at trying to take gains? Where would we harvest some of our profits? And so the thing I found interesting is if you combine the 2000 high and the 2007 high, and you ran a support line out, look, it exactly met the 38% fib level at 1590. So I'm not smart enough to know if the 5-year trend is going to break, but if it does, somewhere along the line we're going to want to look at scoring on defense and taking some profits. So these would be different levels that we would look at, and one of the primary ones, if a 5-year support does break, is roughly around 1600 that we would look at trying to cover some of the shorts. As you've seen me do on the other shorts, when we start getting some gains, we try to pull some off the table, but we would probably pull quite a bit off the table at 1600 if it was reached, or bring our stops up really tight. One of the things, this is from sentimenttrader.com, and they're getting this info from the RightX fund family, and I've covered this before, but I can't really talk about it too much, or its importance to me or importance to you. there's all kinds of sentiment, bulls and bears, but this is what people are actually doing with their money. And what this is this is taking the amount of money in stock funds at Ritex and dividing it by the amount of money in cash. And so you'll notice when the market was falling in 2009, people were moving money towards cash. And this is a excess pessimism level and excess optimism level. But essentially, this blue shaded area is essentially what I want to call the $1.50 line to $1.75. In other words, in 2009, there was $1.50 for every dollar in the money or in stock funds, $1.50 in money markets to $1 in stocks. And so this had shown that people had really exited stocks. They had a lot of buying power in cash. They were scared and they had panicked, and it was a heck of a buying opportunity. And then look at 2011. It got back up to 150 again. So we've been long on our slow money since 2011, but here's the situation, folks, is if the 5-year support level would break, people aren't scared yet. They haven't moved to cash. They're still at optimistic levels, and the current reading is 75% below where prior long-term buying opportunities were. So 5-year support hasn't broken, but if it does, this is going to be one of the main tools I want to keep you updated on is let's watch society and what they're doing with their money. And if we see them piling in and they have, I don't care where the S&P is, when we see them really getting this ratio out of whack, 125, 150, 175 to 1, we're going to want to be, I can't imagine where XIV could be and the opportunities, because folks, right in here, if you had bought XIV in 2011, I think it was only up like 400 or 500% in the following years. So there's so much opportunities when these things get really skewed. But right now, even though sentiment polls do reflect, I mean, there's been damage that's happened in the last 4 weeks. There's a lot more indicators that are pessimistic or showing excess pessimism, which could put a floor in the market. But in the big picture, folks, the public is not panicked at this time. One thing I want to kind of talk about is if we would break these 5-year support levels and you want to play the game of scoring on defense, I want to just stop for a second and say if it breaks 5-year support, the most important thing everybody to do is just not lose money. You don't have to score on defense. It's just let purchasing power become your friend. It's not lose money. But if you do try to score on defense, please make sure you know the tool that you own. So I know the answer to this, but we're going to go back to 2007-8, and if you were smart enough to say, I think emerging markets are going to crash, I think they're going to fall 50%, what would you do? Well, an easy move would be obviously to avoid it, and another one, if you really thought you were going to be right, is how about you go buy the 2x inverse emerging markets. And so if you knew that emerging markets is going to fall 50%, how much money do you think you'd make in that 2x inverse? Well, let me just tell you, sometimes these things have enemies, and volatility can be an enemy. So this is January 18th of 2008 to January the 2nd of 2009. We were really smart. We had this crystal ball, and emerging markets fell 46%, and so you decided you were going to just buy and hold this 2x inverse ETF. Look at the numbers. So if you were long emerging markets, you lost 46, but if you owned the 2x inverse, you lost 37. Now, at one time, you were up 150%. But if you held on to it through this choppiness, it doesn't really show choppiness, but I think if you lived through it, there was a lot of that. You can just see it just ate away those gains. So if, number one, like I bought the 2x inverse biotech earlier this month. Why did I do that? Because there isn't a 1x with volume. I just want to say I only buy a 2x or suggest to buy a 2x if there's a 1x inverse, if there isn't a 1x inverse with volume available. Because all that buying a 2x helps you do is if you're wrong, it just makes you twice as wrong. And so this is not ever my preference, but I just want to share, folks, that if the world would decide to break all these 5-year channels, please know what you're looking at purchasing, because in these flash crashes, we've seen a lot of false pricing. And I think there would be nothing more frustrating to look in the mirror and say, I worked hard, I was accurate on the call, I got the direction and everything, but excuse my French, but my choice of ETF sucked. And that can happen, folks. There's some warts and there's some broken pieces out here with some of these inverse ETFs. So don't always think it's just extremely easy on the short side. So please, again, I'll get off my little perch here, but know what you're buying and know what some of its issues could be. Again, the power of what if. We're going to talk currencies for a little bit. And some of you may say, Chris, I don't have currencies in my 401k. I don't trade currencies. Doesn't matter. And I'm going to say it does matter. Because the way I want you to picture this is countries are worth a lot more than their stock markets and their bond markets. So in other words, when you think of a dog wagging a tail, the dog is the currency markets, everybody, and the tail is the result. It's the stock and bond and commodity markets. So this is the US dollar yen. And I just want to share that in 2007, when the yen peaked here, and it started falling in 2007, what happened to all of the stock markets in the world? I mean, all of them. They fell. That's when the financial crisis took place. So you'll just notice from a resistance level, we're right back where the 2000 peak was before stocks started falling. So you'll notice once it broke support, it started falling and stocks followed. Is there any other resistance that's in play? Yeah, so this is a long-term chart. So over the last 25 years, you can see the dollar yen has hit this resistance, and so now we're facing a really key level up here. So here's the bottom line. Here's another support line coming in. As long as the US dollar yen pushes higher, and if it breaks resistance, the odds are extremely high that the 5-year support levels, they all hold. But if this yen gets weak and breaks support here, 5-year channels probably go right with it. So if you get up in the morning and you wonder how the stock market's doing, I encourage you just for the heck of it, go look at the yen first. Just do that for the heck of it. And if you look today, I think the yen was one of the few currencies. This is the dollar yen. This was weak today. Stock markets were weak. We're going to look at the opposite. Here's the yen. And today the yen was strong. But here is what? Long-term support line. So the trend in the yen is definitely down, everyone. But what's it's facing? Here's support and here's resistance. So here's, to me, a very bottom line. If the yen can break above 87 to 89, I bet the 5-year channels give way. And if the yen can turn around, the Japanese government tried to devalue the yen last week. I think it fell, what, 200 basis points in a day. If it can break this 35-year support, it's going to be very bullish for stocks. So please, I encourage you to stay on top of some of these currency markets, and particularly the Japanese yen and its inverse relationship to the global stock scene. And here's why, to me, it's extremely important. This is the possibility. Let me reiterate 2 or 3 times. The trend is down. The trend is down in the yen. But as the yen in the prior slide, we saw it was hitting a 30-year support line. There's a possibility this is an inverse head and shoulders. In other words, it's a bottoming pattern. And then this is the neckline. So last week when the neckline was hit and it backed off, stock markets rallied. That's what we saw toward the end of the week. But here's the flip side. Here's the US dollar Japanese yen, which could be a head and shoulders topping pattern. So this is why I say if it breaks above 87, it'd be a break above that neckline. That's probably bad on stocks. And if it breaks below the neckline, it's good for stock. It's bad for stocks as well. But right now, long as the yen is below the neckline and the US dollar yen is above the neckline, that's bullish for stocks. So we have such a beautiful convergence of things going on. And that's why I say I think movement is going to be large, and it's going to be our friend, and the opportunities are going to be probably pretty plentiful for the majority of the year. Another what if. Here's crude oil. We've all been hearing the correlations of crude oil. This is a monthly chart going back 30 years. This movement down here was this past month's movement. In other words, that had a chance of being a bullish wick. So you have 2 25-year support lines that were taken out, and during the month crude was down hard and then it rallied back. And then it hit resistance. It closed the month on the resistance. And how has crude done the first 2 days of this month? Pretty poorly, as we all know. So stocks, most likely on a correlation basis, are weak with the crude oil below this double support, double resistance line. And if at the end of the month or at next month's connection series, if crude oil is above this dual line, which it could be 30 days from now, everybody, after historic declines, I bet the 5-year channel lines hold. So another really key ingredient to the whole puzzle is what does crude do with this dual resistance line? So here's the Thomson Reuters Commodity Index, another just monster key pattern we shared in July of 2014 at the upper right. This looked to be a right shoulder, and if the read was correct, that we'd see a collapse in commodities. We've seen that. So now I want to just talk to you about how important this neckline comes first as support, and a major bounce could take place off of support. We can't rule that out. But what we want to look at is from a risk-on, risk-off chameleon perspective. What action would you take, plan A and B? Here's the thing that we got to be aware of, everybody, is we know commodities have been ugly. Could they get uglier? They could get a lot uglier, everybody, if this pattern read was correct. So if we take the distance from the head to the neckline, this would be the measured move. How far could commodities fall if they break the neckline? There would be the measured move, and then watch this. All of those lows happen to coincide with the measured move of the head to the neckline from the neckline below that. So if commodities would break this neckline, the measured move would suggest another 50% decline in commodities. And I know that's huge. They've already fallen enormously. They've never been down 5 years in a row until what we've seen. But I can't emphasize the opportunities that can come if this neckline gives way. We're going to want to short oil. We're going to want to short several of the commodities. If we can get a bounce off of here, because this is support right now. This is a support test to see if a counter trend move can take place. This is really big, everybody, and I think macro implications will come from what takes place at this neckline and will greatly impact our portfolio positioning going forward. So oftentimes we go to a restaurant and it says catch up, but there could be a day that this could catch up. Over the last, since June of last year, crude oil is down 51% versus stocks are down 10%. And we hear so much about the correlation between crude oil and the S&P. I don't know if this is going to happen, folks, but if the markets would decide to play a game of catch-up, there's a lot of space between a -10 and a -50 that the S&P could catch up. And so that's where we have to be aware of plan A's and B's if 5-year support breaks, because these type of reversion to the mean could happen. You know, when you see this type of a spread between the two, probably sounds crazy, but when the spread is that big, you'd want to be shorting the S&P and longing crude oil when it's that fish mouth pattern that I've talked about over many times over the last few years. So I think the key to here is where's the world, where's the governments, the central government's going to take things, have really good plan A's and B's, and I'm trying to help everybody, you know, with that. We're just trying to enlarge portfolios, folks, and I think there's going to be some great opportunities to expand, you know, beyond today. And here's one of them. It's a busy chart. We're getting very close to the end, but this is silver going back 45 years, and in the summer of 2014, silver had fallen almost 50%. And at this point in time, we suggested that if silver would break at the $28 level, that it could fall 50% more, very similar to what we just discussed in the measured move with commodities. So the measured move has now been completed. That its target at that time we shared was at least $14 or 15, excuse me. So it's broken below that. You can see it's trading at $14.39. So you have a measured move calculation, and it's at a fib potential support level. And so from a plan A and B, here's some I believe will end up being a massive opportunity for us. This is the same silver chart that you'll notice that the decline from $50 down to $14 is hitting a long-term support line. It's hitting the 23% fib, and this is a bullish falling wedge, which suggests that prices turn higher 65% of the time. If support gives way at 1, we will want to short silver, because then the current trend that's down would probably pick up speed because of breaking all this support. And if silver would break above this, remember silver has just had its second worst 3-year performance in all of history. That's on an outlier. So even if the trend would stay down, there's a possibility of an upside counter trend move here that could be pretty big. So plan A on a breakdown would be to buy ZSL. That's the double short silver ETF. And then if there's a breakout to the upside, SLV, and which is just the silver ETF itself or silver futures. And if we would get a break to the upside, we'd want to watch SLW, which is silver wheaten. So I think there's a lot of opportunity. This pattern is very compressed. I'm getting this to you right now because there's hardly any wiggle room. So something's going to give here soon, and I wanted you to be aware of that. Another what if? Well, I don't know if we're going to have an up or down February, but we put together, and we'll email this to all of you, the top 20 stocks that over the last 10 years have historically performed the best in February. And so you can see the average returns in this column. They all required at least 10 years of data and at least a 70% positive return during the past 10 years. So for those of you that have enjoyed these lists, here's the February list that we'll get to you. So here's the best, and then here's the worst. And again, we'll get those emailed to you. So I think there could be a lot of adapting to do from a 5-year trend that's in a bull trend. If it would break, we would want to move from a risk on to a risk off perspective. If those moving averages would turn down and we get a support break, this is where we want to be really careful and opportunistic here. I don't think it's going to be decided in just by tomorrow or next week or even a month from now. I'd be shocked if we don't see some chopping around here. But if support does give way, I think selling could really come forward, and that 1690 or that 1600 level is about 15% below current prices. So if we break 5-year support, I think we could see a 15% decline, pretty quickly. Great opportunities ahead, everybody. I appreciate all the kind emails that I've gotten from how it's impacted your lives, and some many of you have talked about the peace of mind that this has helped with. I'm very humbled by those and appreciate your business. I'm going to try to do my best at this end, and like I said, try not to screw up a good start to this year. So again, thank you so much for your attendance today, your membership, and I look forward to working with you and for the months and years ahead of time.